we will come for the principle of business. Why it is for liquidity versus profitability. Liquidity means how much cash you have in your hand, and profitability means how much you will get profit from those type of cash you have in your hand. For example, you are running a business and your business is going very good now. Now you think for bear the current expenditure like utility bills, house rents, wages, you will keep maximum amount of money to you, and a little portion of money will give to your bank to earn a certain amount of money. This is one scenario. And second scenario is you will give the maximum amount of money to the bank to earn a certain amount of profit, and you will put a little bit of cash with you to bear the expenses and other stuff. Now, unfortunately, suddenly you face that you need to buy a machine for expand your business, and due to customer demand, it is mandatory to buy it. Since you all the maximum of the money put in the bank, then you have the capital crisis. It means you cannot buy the machine immediately. That's why you will face this type of crisis. So huge investment will give you less profit. On the other hand, if you put the maximum amount of money with you, then this will give you a very less profit from the bank. So you have to balance between the liquidity and the profitability. Here it says huge cash decreases profitability. It means when you have huge cash with you, then it will decrease the profitability from the bank you are supposed to get. Then excess investment for the purpose of high profit causes cash crisis. Cash crisis means you cannot buy the machine to improve your business. So excess investment is not good. On the other hand, huge cash is not good as well. So you have to balance between the huge cash and the excess investment so that you can run your business properly. Then the second thing is competence principle. Competence principle means we have some daily expenses, right? So these daily expenses will be covered by the current assets, and the fixed assets expenses. Fixed asset is covered by the fixed expenses. The current assets can be the utility bills, then your daily shopping, then house rents. These are your current expenditure. So this current expenditure can be covered by your current assets. Current assets, what can be the current assets? Current assets can be your income. Then current assets can be a small portion of your business profit. Small portion of your business profit. So if you take loan for the fixed assets to bear the current expenses, then it is quite impossible to repayment these loans. So you have to be careful which asset is used for which expenses. If you use the fixed asset for the current expenses, then this will be the disaster for your businesses. And then the main thing is diversification and the risk distribution. For example, if you are a sole proprietor, if you have a sole proprietorship business, you will earn by your own, you will enjoy the profit by your own, and you will face the loss by your own. And if you have only one product, or you have different types of product, there are two types of division. Like if you have one product, then you will only advertise this product only, and you have 2 or 3 products, then you will advertise those 3 or 4 products. Now, diversification means business is such a thing that cannot be fixed by the environment or by the market. Like whatever product you have, you cannot say that this product will go long and long. This will be changed by the market demand. So diversification is really very important, because if one of your product is giving you loss, another product will give you some profit in uncertain market. So for this diversification, your risk will be distributed. How is that? If your one product is giving you some loss or risks, then another product will give you some kind of profit which will covered by that loss. So it is very important, the diversification in the business as well as the risk distribution.